Hello everyone, welcome back to my channel. So this video marks the end of week number 70 in this road to 100k realized return challenge. And this has been a week of mixed feelings. On one hand, we managed to collect very little premium. I don't think we even reach 100. So yeah, we close this trade on actually this trade was expired. This option that we had still open expired, so we collected 255, and these positions we closed, these last two we closed also during this week, and the sum of this is 98.70, so not even $100 this week. However, we still have a few positions open. We have still our five QQQs calls open here, and we still have our three puts that we sold on the XLF. And of course, we cannot account for these because the positions are not yet closed, so we'll have to wait until the end of the next week to see how it transpires. However, a few interesting things happened this week, and apparently the net outcome of all this is that markets went up, and again, to focus on the Qs, you'll see here that it was pretty much, except perhaps here, it was pretty much smooth sailing all across the week. Markets have recovered, and even though a few ups and downs here and there, but for the most part it was pretty much smooth sailing. And going back, this happened on the basis of, even though the US retail sales came, I would say, more or less in line, so nothing really to say in here, but the PPI, the producer price index, as you can see, came softer than expected, and this was also beneficial in terms of seeing where the market could, or where the market would go. So it had a relatively positive impact, and but this was not the most critical finding or the most critical piece of data that happened on Tuesday. And here you'll see that it's the consumer confidence. And the consumer confidence, even though it's not in here, it took a big plunge here. It slumped to 88.7, and you'll see here it came down from a reading the previous month of 94.6, even though it was expected to drop to 93.2. So it was pretty much a low blow for the market. But even so, because this situation can be a catalyst, even though not that relevant, but can be a catalyst for an interest rate cut. This was something that ended up benefiting the market. Also, I think the jobless claims, initial jobless claims, again, not in here, but I think they came pretty much perfect, because they came slightly below we expected, but not that low enough to be able to say that the job market is going absolutely fine. And because in that way it would mean that there may not be much of an incentive to lower interest rates. So this reading came just perfect in my opinion, and that also contributed to continually pushing up the market. Again, there was no trading on Thursday due to Thanksgiving, and Friday trading day, it was a shorter one because of the holidays season due to Thanksgiving. And here you can see that it just the markets closed at 7 o'clock here Central Europe, and that means that it closed up at basically 2 o'clock in the actually at 1 o'clock in the in the east on the east coast of the United States, and this was actually what turned out then a huge spike at the end of the day. Also, another development that took place on Wednesday, and this was an important one: the Beige book, which is published 8 times per year, and the Beige book, this was released by the Fed. It gave a lot of signs actually that even though of course there's some concerns with inflation, especially when it comes to the pass through of higher input costs to consumers, but for the most part it gave some signals that there would be a rate cut in December. And the result of all of these pieces of information that came out, this is the current place or the current expectation. So there's an 86.4% 86.4% probability that the Fed will in fact cut interest rates by 25 basis points on the next meeting on December the 10th. Now, there is other pieces of information that the Fed will use, and some of those are of course important and will be coming next week. For example, the ADP employment, another round of jobless claims, some Fed speak, and this one especially by the Fed chairman. Again, the PCE, which is extremely important. This is the most favored inflation reading for the Fed, because this is the actually the price index that impacts the consumer expenditures, and so this is really important one for the Fed, and of course the consumer sentiment as well, but it's not as important. Some more Fed speak. We have here some Fed speak as well. Another Fed speak here, and I think that's pretty much it for this. Is yeah. So yeah, actually, yeah, I was looking at the wrong place. So this is what actually matters. So there is some Fed speak here, ADP, and yeah, and then the PCE. So this is going to be a big one for next week, and that's pretty much it. Now, considering all of this that took place, we have in here to see that because of this recovery of the market, these calls, which were of course sold at even in the previous week, you can see here that, and pushing back here, you can see it very well, but it was a point. There was a point in time in which they even came up right around the 20 somethings, 30 cents a piece, but then it came down to where it is at around between 16 and 18. And so because the market recovered, these calls became more valuable, and so they were not ready to be bought back at 1 cent or 2 or 3 cents. And so now we have to wait until either this expires out of the money or expires in the money, and in that case our shares will be sold. But in any case, it's a positive development, because I believe we may be very close to touching distance of our strike price, and by enough of a margin to be able to sell again 0 DTE calls. Let's see. So it's at this point, of course, we are dealing with not with actual market data because the markets are closed, but in any case, I think that we may be able to start selling, if the price stays like this, to start selling some calls with 2 or 3 days of maturity, which is already a progress from being forced to sell options with 1 week of maturity. So we would definitely appreciate a bit more, being a bit closer to the actual strike. We do, even if we don't hit the 630, if we stay at around 626, 628, it's going to be already good enough for us. And so this is something that we'll have to hope for next week. Now, an interesting one, and I never saw this one coming, was this call right here, this 53.50 call that we had on XLF. If you saw my previous video, I mentioned that it was ready to be bought back. It was not being traded anymore. We could have bought it back at 1 cent, but that would have meant that most likely this profit will disappear and would become a loss, because we have to buy at 1 cent and then pay a commission on top of it. And if even if we pay a little amount, 38 cents, if it is more, it may have seriously impacted our profits. It would be like a sort of a 20 or 30% commission fee just to close a position. There was no point in doing so, and so we'll just let it expire. But interestingly enough, because of this strong recovery that the XLF had over this week, as the week progressed, as the week unfolded, the option actually came back alive. And even if you look at the graph yesterday, and here is the 53.50 mark, there was a point in time in which the option was actually in the money, and it was valuable, much higher than the 4 cents that we collected by selling it on the previous week. And so actually I was pretty much hoping that this price would remain above 53.50, and we would finally be able to sell these shares of the XLF that we still have. But because of the pullback that ensued after, and it's the fact that it closed at 53.39, the 53.50 call expired worthless, and we collected the premium, we kept the premium. The option died, and we still keep the shares. And this now brings us our average cost of 52.69, or we might as well say 52.70. But still, because of this current price, we don't know how the markets will open on Monday, but it makes sense for us just to sell the 53.50. Chances are we still are going to collect a fairly good premium on it. We can see it now. The price is not showing up, and the market is closed anyway, so these prices for sure will be different by the time the market opens on Monday. But nonetheless, we will just try to maximize the premium and try to get rid of it, because I honestly, I don't see it, but I can be wrong. I don't see it coming to 54 and being able to sell the shares at 54, but you never know. And it also goes to show that, in looking at the chart here, a stock that started the week below $52 at 51.82, and keep in mind, we are talking about a stock which is a very low volatility one. This is comparable to the S&P 500, and this is a very stable stock. So this kind of a movement is very unusual. And there was a point in time I was thinking, well, probably it would make sense to sell the 53 call, because it will not get there for sure, and we collected a little bit more premium. But if that was the action that I took in this case, we would have sold the shares. We would have taken a $50 capital loss, even though we would remain in a profit due to the premiums. But still, this is how the market dynamic can absolutely crush you. And that is why we simply cannot take the risk unless we are just like one day, 1 day or 2 days to expiration of the option. When we have a full week ahead, that's not the best idea. And yeah, and keeping in mind that when we actually sold this call was sold at on the 20th of November. You'll see that, and I recall this very well, that we sold this call when prices were around here. So it was even below 51.50. So if you imagine how much it had to rise to reach here, this is a climb, this is a rise or appreciation of 4 or 5%, which is very, very high given the volatility of this stock. So yeah, apparently things turned out this way, even though we did not sell the shares. But yeah, we will continue to get some more premium out of this, and hope in the hope that we sell the shares through the calls, because we cannot sell it outright. We are restricted from trading directly these shares. So we'll have to wait and see. These puts most likely will expire worthless. I given the dynamic of the market, which is in a recovery pattern, I don't see the price coming back to 51 for these puts to become exercisable. So yeah, we'll see. But for the time being, this is all. Feel free to leave your comments in a comment section down below. And of course, I'm available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And we will convene on next Monday in the evening, or on Tuesday morning, to start the week number 71 in this challenge, which will be again a full week with the 5 days of trading. And yeah, I'll see you there.